Our next guest says the door is now open to retesting the June lows. That's about a 6% decline from here. Joining us now, Jonathan Krinsky, Chief Market Technician at BTIG. It's good to see you. So you're still holding on 30. I mean, does this count as 3,900? How can it not? We're equivalent about a 0.01 points.
Yeah, look, Scott, we look at the weight of the evidence, not just one given price level. We know that 3,900 was tested a couple weeks ago, held, and then we obviously sold off post CPI last week and closed below for the first time since July on Friday. So, it's not so much that one day, makes or breaks the trend, but I think when you look at how important 3,900 was, it's the most amount of volume is traded at that price level over the last 3 years of any given price level in the S&P 500. And you combine that with some other factors, to us it does suggest the path of least resistance is probably lower at this point.
Did this move today, it was a pretty stark reversal. Did it surprise you?
We're just looking at, if you look at the trading action in the last month or so, we rallied hard into the Jackson Hole event, and then we got rejected firmly to the downside. Then we rallied hard into CPI last week, and then got rejected hard to the downside. And I think it's just a bit of covering ahead of potentially a catalyst on Wednesday being the FOMC. So, look, the market doesn't work in straight lines; it works in trends. And I think the trend for most timeframes is still lower, but you're going to have these counter trend rallies in between.
Well, what if Powell does what Josh Brown thinks may happen and just doesn't shock us, right? Like, what could he or they possibly say at this point that's going to shock you? Now, 100, if they go 100, I think that would be a shock to many because I don't think people really don't expect that that's going to happen. But what's going to surprise us at this point?
Yeah, no, I mean, look, the macro is one element. Then you can get into the micro with earnings. Your previous guest was talking about what could happen with earnings. So, all of this goes into the mix. But I think at the end of the day, when you look at, what the market's doing, what it's telling us, there's just some signals that are not consistent with what we've seen at bear market lows. And one of them, we've talked about this before, the VIX curve, every major market bottom over the last 15 years has not culminated until you've seen a 10-point inversion in the VIX curve, meaning spot VIX is at least 10 points above second month future. We haven't seen that at all. We haven't even gotten close to that at all this year. And then the second point is, we looked at the S&P on a monthly basis back to 1929, and every major bear market bottom, meaning when you've gone down 20% or more, we have not seen a market bottom until the monthly RSI has gotten below 42, with the exception of the 1987 crash, which wasn't really a bear market. It was a 3-month crash. So we're at about 47 on the monthly RSI now. So there's just a lot of things that suggest that, we haven't seen the final low. Short-term trading aside around macro events, to us, that just speaks to the fact that, again, despite the fact that people say they're bearish or have capitulated, history says that we haven't seen that yet.
So you're looking at mega cap, right? Microsoft, new 52-week low today. Apple's had a nice little move off of its worst levels of last week. Where do mega caps factor into your thinking here? Because they have to somewhere, given the size and ownership.
Yeah, we talked about Apple on your show the last few weeks, thinking that still remains vulnerable. If you look at the relative strength of Microsoft and Alphabet in particular, they're breaking to 18-month lows the last couple weeks. And then you look at sentiment on those, there's still over 90% of sell-side analysts have buy ratings on both of those stocks. So, I think there's still some risk there. And then when you kind of look at, how mega caps have traded, and then, typically what happens in bear markets, as bear markets unfold, you see, you start with the smaller cap names rolling over first. We know that small caps peaked, about 18 months ago. And slowly but surely, we're seeing some of these mega caps roll over. So Google and Microsoft have certainly broken down. Apple, looks vulnerable to us, along with Amazon a bit. And then you look at some of the low volatility names, those defensive bond proxies. Those continue, and conversely, are showing very good relative strength. And typically, you don't see bear market bottoms until the defensive relative strength peaks. So, you add it all up, and it just smells to us like we're not quite out of the woods yet.